Hey everyone, Joe here from Avalon Accounting. Today we're diving into a topic that's important if you're a Canadian business owner or an investor, the dividend tax credit. Now, I know this isn't the most thrilling topic, but understanding the dividend tax credit can save you some serious money. When you earn dividends, they are taxed differently than regular income, and that's exactly what I'll be explaining. You'll learn what the dividend tax credit is and why it exists, the difference between eligible and non-eligible dividends and why it matters, and how to claim the credit on your tax return. I'll also explain why it can appear that you are paying low tax on dividends, but why that's not exactly true. By the end, you'll have a solid understanding of how this tax credit helps reduce your tax bill, whether you're running a corporation or earning dividends from Canadian stocks. So let's get into it. All right, first things first, what is the dividend tax credit and why does it matter? Dividends are essentially a portion of a corporation's profits that are distributed to its shareholders. For example, if you own shares in a company, the dividends you receive are your share of that company's after-tax profits. But here's the thing, because the corporation already paid tax on those profits, taxing you again on the full amount wouldn't exactly be fair. That's where the dividend tax credit comes in. The dividend tax credit is Canada's way of reducing what's known as double taxation. It gives individuals a tax break when they report dividends on their personal tax returns, but only to the extent that the corporation has already paid some of the tax. Essentially, it makes dividend income appear more tax efficient than other forms of income when reported on your personal tax return. Here's a quick example. Let's say a corporation earns $100 in profit. It pays taxes on that amount and then distributes the remaining profit to you as a dividend. Without the dividend tax credit, you pay taxes on the entire amount again, even though part of it has already been taxed at the corporate level. The dividend tax credit steps in to prevent that. It's important to note that this tax credit is specifically for individuals receiving dividends from Canadian corporations. If you're receiving dividends from a foreign company, or if your corporation is earning dividends, the tax credit doesn't apply. Not all dividends are created equal. There are two main types of dividends in Canada: eligible and non-eligible dividends. Eligible dividends are typically paid by large public corporations or Canadian-controlled private corporations or CCPCs that are taxed at the higher general corporate tax rate. Because these corporations already pay a significant amount of tax on their profits, the government offers an enhanced dividend tax credit to shareholders receiving these dividends. Eligible dividends are grossed up by 38% for tax purposes. And that means the amount you report on your tax return is artificially increased to reflect the pre-tax amount. But don't worry, the enhanced credit offsets this. Non-eligible dividends, also known as other than eligible dividends, are paid by CCPCs that benefit from the small business deduction. These companies are taxed at a lower rate, which means the dividends they distribute receive a smaller dividend tax credit. Non-eligible dividends are grossed up by only 15%, which results in a lower taxable amount than eligible dividends. The corresponding tax credit is also smaller to match the lower corporate tax rate paid by the company. We can quickly summarize the key differences. Eligible dividends have a higher gross up and also a higher tax credit. Non-eligible dividends have a lower gross up and also a lower tax credit. It's worth noting that foreign dividends, like those from the US or international stocks, don't qualify for the dividend tax credit. Instead, they're taxed as regular income, which can result in a higher overall tax bill. Understanding the difference between eligible and non-eligible dividends is key for tax planning. For example, as a business owner, knowing what type of dividends your corporation is paying can impact your overall tax strategy. Now that we know what the dividend tax credit is and the difference between eligible and non-eligible dividends, let's look at how it actually works. When you receive dividends, the first step is the gross up. This artificially increases the amount of dividend income reported on your tax return to reflect the pre-tax income the corporation earned. Here's how the gross up works. Eligible dividends grossed up by 38%. So if you receive $100 in eligible dividends, you'll report $138 of income on your tax return. Non-eligible dividends grossed up by 15%. If you receive $100 in non-eligible dividends, you'll report $115 on your tax return. This gross up ensures that dividends are taxed as if you were receiving the corporation's pre-tax income. Now, once the gross up amount is included on your taxable income, the dividend tax credit comes into play. It reduces the tax owed on that grossed up amount. There are two parts to the dividend tax credit. The federal dividend tax credit applied to your federal taxes and calculated as a percentage of the grossed up dividend. And provincial dividend tax credit. Each province and territory offers its own credit, and the rates can vary depending on where you live. The combination of these credits ensures that you're not overtaxed, making dividend income as tax efficient as other forms of income like interest or salary. This system may seem a little complicated, but it's designed to achieve what's called integration. The idea is to make sure the total taxes paid by both the corporation and the shareholder are roughly equivalent to what the shareholder would pay if they had earned this income directly. The important thing to remember is that the dividend tax credit doesn't eliminate taxes on dividends, but it does significantly reduce them. By offsetting the taxes you owe on the grossed up dividend income, the credit ensures that you're not taxed twice on the same corporate profits. The dividend tax credit is designed to help individuals who receive dividend income from Canadian sources. If you're a shareholder in your own Canadian corporation, the dividend tax credit can play a big role in how you choose to pay yourself. Many business owners take dividends instead of or in addition to a salary, and there are quite a few moving pieces that come into play when deciding how to pay yourself as a business owner. So for that reason, we've got an entire separate video on salary versus dividends linked in the description below. And if you hold shares in Canadian corporations, particularly public companies, the dividend tax credit makes dividends a great source of tax-efficient income. Often, as an investor, you don't see or care that the corporation has paid tax on its income before sending your dividend, so it appears to be taxed at a very low rate. Eligible dividends from Canadian stocks not only provide you with steady income, but the credit also helps reduce the taxes you pay on that income. The dividend tax credit is a valuable tool for reducing your tax burden if you're a Canadian business owner or investor. Just be wary of claims that this money is tax-free. It's not technically correct to say that because the corporation has already paid some tax on your behalf. For most people, claiming the dividend tax credit is simple. Just enter the information from your tax slips into tax software or hand over those slips to your accountant. Here's how it works. Step 1, gather your slips. When you earn dividend income, you'll receive tax slips that detail everything you need to report. These include T5s, which are statements of investment income, so those would be for most dividends. T3s are statements of trust income allocations for mutual funds or certain trusts, or a T4PS or T5013 for profit sharing plans or partnerships. These are less common though. Step 2, enter the information into tax software. Either simply plug the numbers from your tax slips into your tax software and it will handle the gross up and apply both the federal and provincial dividend tax credits automatically. And step 3, review and file. Double check the summary in your tax software to ensure that credits have been applied correctly. If you're working with an accountant, they'll take care of the calculations and reporting for you. And that's it. For most Canadians, claiming the dividend tax credit is as easy as entering the numbers from your tax slips into tax software. Just make sure you have all your slips organized and you're good to go. The dividend tax credit is a valuable tool for reducing the taxes you owe on dividend income from Canadian corporations. Whether you're a business owner deciding on how to pay yourself or an investor looking for tax-efficient income, understanding how it works can help you save money. If you like this video and would like to learn more about how to pay yourself as a business owner, make sure to check out our salary versus dividends video linked in the description below. And if you're a business owner looking for personalized advice on dividends or tax planning, we're here to help as well. So reach out to Avalon Accounting and we'll help you through it all. All right, that does it for this video. Thanks so much for watching and we'll see you in the next video. Cheers.